Hi, it's Michelle Costin again, and we're going to continue our debriefing on Stephen Corp, which was problem 18.6 in the textbook. We're going to look now at the schedule of deferred tax asset or liability. I want you to imagine for a moment that you're the accountant, either in-house, preparing the corporate tax returns and the financial statements, or a member of the auditing team, or just the accountants in charge of preparing the financial statements, so that each year there's consistency and you understand what's happening. This schedule is part of working paper files, and I really wish the textbook clarified that. It is in itself an important means of tracking an asset or a liability. Okay, so we're going to jump in. I've set this up in Excel just because it's nice and easy for you to read and to see what's going on. We're still using problem 18-6 in the textbook, Stephen Corp. And right now I'm looking at the second piece of information. This is where it says the carrying amount of the company's property, plant, and equipment at January 1st, 2017 was $1,256,000. So this is property, plant, and equipment. It also tells us in that same section that the UCC at that same date was $998,000. Now I want you to note that in the textbook it says that was the balance on January the 1st, 2017, because technically in this question we're only doing 2017 and 2018. But the opening balance on January 1st is the same as the closing balance on December 31st, and so I can recreate the schedule that the accountant was using. The tax base is the first column, the accounting base is the second. The difference between the two then tells us that the taxable difference is $258,000. The question also tells us in part 7 that a 30% rate of tax has been in effect since 2015. So I know that in 2016 it was 30%. This final column is simply the taxable temporary difference times the tax rate. That tells me the deferred tax, in this case, liability amount. That's what was shown on the December 31st, 2016 Statement of Financial Position for the deferred tax liability. And that's where we start for 2017. But we're not done yet. In part 3 of the question, it talks about the restructuring charge, and it also gives us information at December 31st, 2016. In this part of the question, it tells us that at December 31st, 2016, an accrued liability of $199,500 remained outstanding relative to the restructuring. So that's an accounting number. Remember that it tells us it's a liability, so we'll put it in as a credit. Because for tax purposes, the restructuring costs are being deducted as they're paid, so on a cash basis. So there is no asset or liability for the tax purposes. So we have a temporary difference, deductible amount of $199,500. We'll be able to deduct this for tax purposes going forward. Tax rate still 30%. And now we have the full amount. We have a liability amount, we have an asset amount, we can combine the two, and we'll show that on the Statement of Financial Position, a deferred tax liability of $17,500. Okay, so let's take a look at what happens in 2017. Now, I've shown both the 2016 and the 2017 working papers on the same screen. just so you can see the continuity easily. In 2017, we take the information that was contained in 2016 and we enter the prior balances, carry forward amounts. And then we look to see what the tax base and the accounting base is at the end of December 31st, 2017. For property, plant, and equipment, which is in part 2, it tells us that the tax base of $998,000 will have been reduced by the CCA of $192,000. You can see that in the question, of capital cost allowance that was claimed in that year. The accounting base is going to be reduced by the depreciation. So we started with, at the beginning of the year, $1,256,000. We took depreciation in 2017 of $175,000. So we have $1,081,000. For the restructuring, we look to part 3, where it talks about how much is remaining in the liability for accounting purposes. And it tells us that the balance, the liability, was reduced to $68,000 at the end of 2017. So we know again, for the tax purposes, there is no amount because it's on a cash basis, but the accounting base is a $68,000 liability. So 0 minus a negative number gives us a positive number here of $68,000. Remember here that that's a deductible temporary difference. We'll be able to deduct that in the future as those costs are actually incurred for tax purposes. They were already deducted for accounting purposes. We also find in 2017 that in part 4 that property held for development was sold and a profit of $52,000 was recognized in income. So it was all recognized in income. There is no asset or liability associated with the sale of that property. So I'm just going to call this profit. And what exactly you call it doesn't matter so much. And again, in the working paper file, you'd want to clarify exactly what that was. But for the tax base, we're only bringing it into income at the same rate that the money is being received. So you remember that for tax purposes, we brought in $5,200 worth of income, 10%, which means that there should be $46,800 that is going to be taxable in the future. And you can see that in this column, taxable temporary difference. So this is the amount that has not yet been taxed. It was all brought into income for accounting purposes, but $46,800 will be brought in over the next 3 years. Again, we have this constant tax rate, of course. Put that in all 3 columns. Now we can see that the deferred tax liability on the financial statements, on the balance sheet, is $76,140. At the beginning of the year, or at the end of last year, the amount showed as the deferred tax liability was only $17,550. So we have to figure out what amount we're going to adjust the deferred tax asset liability account by. Keep it really simple. The difference is we want to end with $76,140. The opening balance was a liability of $17,550. We have to credit the deferred tax liability account by $58,590. So we'll have a credit to the deferred tax liability account and a debit to deferred tax expense. Does that make sense? Let's move on to 2018. We should be able to move through this fairly quickly because I think now the concepts are a little clearer. At least I hope so. Again, we set up the worksheet This would be in our 2018 working paper files. We transfer the balances forward so that the $76,140 credit balance in the deferred tax liability account is shown as a prior balance here. And we have the different accounts that we were using. We look for the new information, so the tax base for 2018 is going to be the UCC at the end of 2017 less the depreciation that was taken in 2018. And for that we look at Part 2, and it says CCA for tax purposes was $163,500 for 2018. So we know that the UCC at the end of 2018 is now $642,500. For the accounting, we do the same thing. We say the balance at the end of the prior year was $1,081,000. We can see in Part 2 that they did take depreciation in 2018 of $180,000. The restructuring, still zero for the tax base, but for the accounting, we look at Part 3, it says that it was zero at the end of 2018, so we can simply put zero in there. For the profit, we're going to look again and see what the balance for the tax purposes, how much have we not yet brought into taxable income? And we can see the amount is $31,200. Accounting, we brought it all into income for accounting purposes. So we can see that there is still $31,200 that has not yet been brought into income for tax purposes. All by 30%, we can see that the deferred tax liability balance at the end of 2018 is $86,910. The prior balance was $76,140. That means that we have to credit the deferred tax liability account with $10,770, which will be a debit to the deferred tax expense account. Does that all make sense now? Is it getting any clearer? I hope so. Thanks for watching.